When headlines scream incoming recession, most investors do the same thing. They panic. Stocks dive, portfolios bleed, and fear takes the wheel. Suddenly, the market feels like a minefield. But here's what almost everyone forgets. Recessions aren't some freak event. They're not rare, random disasters. They're part of the game. We've seen this movie before. 2008's financial meltdown, the dot-com bubble, the COVID crash. Each one felt like the end, and yet, every single time, the markets bounce back, stronger and more resilient than ever. The real danger is not the recession, it's the reaction. Panic is what turns a dip into a disaster. Fear makes people sell low, chase losses, and abandon the plan they worked so hard to build. In this video, we're breaking down 5 timeless, no-nonsense moves that can make your portfolio recession-resilient. While you can't control when a recession hits or how deep it runs, you can control how financially resilient you are when it happens. What is a recession? First, we must understand clearly what a recession is, as well as what it is not. It is more than just a scary headline or a dip in the stock market. A recession is the decline in economic activity that persists for months or even years. In technical terms, it means that a country's gross domestic product, its GDP, declines for 2 consecutive quarters. But what does that really mean? Honestly, it typically shows itself alongside rising unemployment, falling markets, and business cutbacks. In 2008, the housing market crashed and caused a global financial crisis. Millions of people lost homes, jobs, and savings. Before that, in early 2000, the dot-com bubble burst, leading to hundreds of millions of dollars being wiped off overvalued technology companies. Recently, in 2020, the COVID-19 pandemic brought down the S&P 500 by over 30% in just a few weeks. However, this is what history teaches. Markets fall, but they recover. If you look at the S&P 500, it will show sharp drops followed by long-term growth. So investing for the long term is the first step in making your portfolio recession-proof. 1. Stay the course. Don't panic sell. Fear can drive the stock markets whenever they fall. Many investors go through a panicky phase to sell their stocks to either save themselves from losses or time the market. But history has proven that these decisions can cause more pain. In bad times, investor behavior can build or break your portfolio. One of the greatest wrongdoings? Panic selling. When the market downswings, the instinct is to cut losses and run. This is where investors usually make a blunder. Selling in a downturn locks in the losses, and you miss the ride back up. Warren Buffett has a well-known saying, "Time in the market beats timing the market." This is where the power of compounding comes in. It's growth built on top of previous growth. By staying invested, you give your portfolio the time it needs to recover and thrive. Every good bear market has always been followed by a bull cycle. The 2008 financial crisis saw over a 50% drop, and in a matter of years, stocks were hitting new highs all over again. Likewise, the crash in early 2020 saw a swift fall, with the market quickly bouncing back and setting new records by the end of the year. Staying the course allows your investments time to recover and grow. Recessions are transitory, and the market's long-term trend is upward, so be patient. 2. Diversify, but smartly. The second move in recession-proofing your portfolio is diversification. Diversification means not just owning different stocks, but spreading your investments across various asset classes, bonds, commodities, real estate, or even international markets. So why take this approach? Because when one part of the market goes down, another often holds strong or even performs exceptionally well. For instance, during a recession, stocks might take a hit, but assets like bonds and gold usually rise or stay stable, helping to cushion your portfolio. Diversification also means avoiding overexposure. Many investors unknowingly put too much weight on a single industry, company, or even country. Take, for example, the technology sector. With the likes of Nvidia, Microsoft, Apple, and Oracle, if you are invested too heavily into this sector and it goes through a decline, a large part of your portfolio will feel the pain. But with a well-balanced, globally diversified strategy, the sting of local downturns is often softened by stronger performance elsewhere. You always want to strive to have a balanced portfolio, but even the most well-balanced investment strategy can't protect you from every curveball. That's where our third move comes in. 3. Build an emergency fund. The cash you keep saves you from losing everything when a recession hits. This is the single biggest reason emergency funds are important. As we'd informed earlier, recessionary times typically come with higher unemployment. If you lose your job during an economic downturn, bills and expenses can keep rising and markets can remain low for months or even years. Liquidity, which means easy access to cash, keeps you afloat without having to panic sell already depreciated investments. Experts suggest putting up 3 to 6 months worth of expenses, either in cash or a high-interest savings account. The plan should be that when the market dips, you don't have to take money out of your portfolio and your investments will have time to recover. Federal Reserve sources show that about 1/3 of Americans are not saving enough for even a $400 emergency. This statistic reveals just how vulnerable much of the public is, as any kind of deviation from their everyday norm can cause a panic in the household. Building a solid emergency fund takes care of money matters, as well as peace of mind in times of uncertainty. And while it's not something you'll be able to fully build out in a few weeks or even a few months, starting now and saving just a little bit goes a long way. 4. Dollar cost averaging. Dollar cost averaging is one of the neatest ideas for playing out market volatility. Instead of a grand illusion of timing the market, you simply keep investing a constant amount of money at regular intervals, regardless of what the market is doing. Whether the charts are up or down, you keep investing regularly and consistently. The beauty of DCA consists in its tendency to decrease the average cost per share over time. When prices are low, more shares are bought with the fixed investment. When prices are high, fewer shares are bought. It works in a way to reduce the effect of market flows to minimize the chances of wrong timing in making a significant investment. Let's look at a quick example. Let's say you invest $500 a month into the market. At the time of this recording, the Vanguard S&P 500 fund, the VOO, is about $500 per share, which means right now you'd be buying 1 share a month. But if we were to experience a market decline and the fund drops to $250 a share, then without changing any of your behavior, you'd be buying 2 shares a month. As in the 2008-2009 crisis, those who went the route of DCA kept buying regularly, whereas lump sum investors experienced losses because they were typically trying to time the market. Those who consistently invested bought at much lower prices and set themselves up for massive gains when the market recovered. By reducing emotional involvement in investing, DCA enables you to stick to your long-term strategy. 5. Focus on debt and discretionary spending. Debt is one of the greatest vulnerabilities during a recession. It's like an anchor. When times get tough, it pulls you down faster. Monthly payments to credit cards, car loans, and personal loans don't stop if your paycheck shrinks or even disappears. By aggressively paying down debt while the economy is still relatively stable, you reduce the number of financial commitments that weigh you down. Less debt means fewer bills to juggle if a layoff, pay cut, or unexpected expense strikes. At the same time, reducing discretionary spending is equally crucial. Discretionary spending includes non-essential items like dining out, entertainment, luxury purchases, and impulsive shopping. While enjoyable, these expenses add up quickly and can easily spiral out of control if left unchecked. By building the habit of conscious, intentional spending now, you not only free up cash to accelerate your debt payoff, but also train yourself to live comfortably on a leaner budget, an essential skill during tougher economic times. Focusing on paying down debt and minimizing discretionary spending should never be seen as depriving yourself. Living below your means should never be seen as a punishment. It gives you flexibility, resilience, and choices when other people feel trapped. It's about trading short-term pleasures for long-term security and peace of mind. Remember, a recession is just a phase, a natural part of the economic cycle. But how you respond makes all the difference. There are smart, disciplined ways to recession-proof your portfolio. Diversify, build an emergency fund, and pay off your debt. Techniques like dollar cost averaging and staying committed to your long-term plan can help you weather the storm and come out stronger on the other side. Right now is the perfect time to reassess your portfolio. Not out of fear, but with clarity and purpose. A balanced, long-term mindset will keep you steady, even when the markets feel anything but. Warren Buffett said it best. The stock market is a device for transferring money from the impatient to the patient. If you found this video helpful, make sure to like, subscribe, and share it with a friend. Drop a comment below and tell us your go-to recession-proof strategies. We'd love to hear how you're preparing for the next downturn. Thanks so much for watching. We'll see you in the next one.